Hey, there we go. Let's check YouTube. Seems to be working all right. What's up, Roggle? Oh, good to be back. Good to be back. It's been a year. Rog, I missed you, man. I know you sent me a couple comments trying to get me to do a stream or to do some content, and I've been really trying to get on the content bandwagon again. So that's my big goal for the rest of the year. Let's see. How's everything? Is everything working okay? Let me just double check, make sure. I'm multi-streaming to Twitch and YouTube, so I don't know how well this is gonna work. Yeah, Warren, I can read your comment. Can you see my stuff? It looks like most of the viewers I have right now are on YouTube. So, but yeah, like I said, I'm kind of streaming to YouTube and Twitch right now. I'm just kind of trying things out. You guys ever watch Twitch? I'm Stock Geek TV over on Twitch as well, but so yeah, just playing around with it. We'll see how it goes. All right, cool. Good to hear. Good to hear the audio and video is working. So today, yeah, interesting day in the market today, right? Meme stocks were pumping. Like if you look at all the the old favorites, GME, AMC, Clover Health, BlackBerry, Robinhood, Wish, all those stocks were pumping hard. Especially GME and AMC, still down from their highs, but pretty big day for those. So interesting to see that. Overall market looked pretty good today. Getting a pretty big bounce in small caps. So if we look at the 5-day on, the Russell and the S&P and the NASDAQ, you see the last week, actually let's do a 10-day. Last week you can see how badly small caps were underperforming. And small caps, actually, some of these small caps have had pretty gnarly pullbacks, especially like in the SPAC sector. And yeah, I mean, some of these stocks are down 30-40% or more in some cases, especially the SPACs that already missed guidance. I'm going to turn this music off real quick. I'll pause it at least. So it's nice to see some of the small caps kind of coming back a little bit, especially the last 2 or 3 trading days. You can see small caps actually outperforming the NASDAQ and the S&P. So good to see that bounce. I don't know how long it's going to last, but the Russell index definitely starting to catch up a little bit after pretty bad performance over the last month or two. Yields moved up a little bit. We've got, some of the commodities kind of came back. The supply chain situation is still really bad. There's a lot of congested ports, high shipping costs. That's not really going away. So it's going to be interesting to see like what happens to some of the e-commerce companies and companies that rely on the supply chains through the end of the year as we get into like the holiday season. Yeah, I mean, and that's tough. We saw like Wish and some of the other e-commerce stocks really getting hammered on having issues with not only shipping logistics, but also things like customer acquisition. Like Apple's got that whole privacy update. It made any customer acquisition more difficult because now it's harder to track users from when they download an app to when they actually complete purchase and things like that. So it's hard to run an ad and know exactly what your ROI is now that Apple's made it harder to track. So that stuff's kind of weighing on e-commerce. But I've been kind of, what's up, Rebel? I've been kind of, sifting through some of the stocks that are beaten down. I just love looking at stuff that the market has just totally given up on. So I'm looking at stocks like SmileDirect. I know somebody here on YouTube had mentioned it a couple months ago, and I started looking at it. I actually do have a position, a pretty small position, very small non-core position in it. Definitely in an unrealized loss position on it right now. But that's why today I want to do a dive. There's some concerning things. We'll talk about what I'm concerned about with SmileDirect. One of the things that I really want to focus on too is I'm going to do a quick model here just to kind of do some back of the envelope math to see like what does a cash burn look like, do we think, over the next, couple of years for Smile Direct? They have a $750 million convertible note due in the beginning of 2026. So they gotta go from being cash flow, burning this year, pretty deeply cash flow negative this year, to at least by next year or year after, they've got to be producing pretty healthy cash flow if they're going to be able to either pay down or most likely refi that convertible debt. So that's what I want to look at. I want to do a little model of SDC and kind of figure out where their cash crunch is going to hit, and also what it looks like under some different scenarios. So Scott, yeah, in LS, another beaten down one. Super, super interesting. We're going to talk about this one on another stream for sure. Caught a big bounce today out of nowhere, kind of late in the day, the last hour of the trading session. You can see, Nautilus caught about an 8 or 9% pop here end of day, but still year to date down quite a bit, down basically, call it 50 to 100, 50 to 75%, depending on where you bought it earlier in the year. But I own some of this. I would say it's kind of a small-ish, but not like, it's not a starter position. It's bigger than a starter position for me, but it's less than a core position for me. I'm planning to do a lot of research work on this one in the month ahead. I'm going to try to speak with the management team as well. There's some low-hanging fruit here. I think this business trades for less than the value of the Bowflex brand. I think at a minimum, from today's price, you can get out of this thing with a gain, because I think at some point it'll get taken private if it stays at these levels. But, they're having a pretty good year so far, but the comparisons get tougher as we move into later in the year. And of course, the supply chain logistics issues probably not helping them either. They're seeing their margins get squeezed as well with some of the increased shipping costs and things like that. So, you're shipping heavy products, that's gonna definitely weigh on margins a bit in the short run. But longer term, the whole story with Nautilus, of course, is the subscription business. It's, can they be a legitimate number 2 or number 3 to Peloton in the connected fitness space? And if they can carve out any reasonable amount of market share there, that high margin subscription software can be, very additive to their bottom line of their operating income, which means, you get an operating income increase potentially over the next 4 or 5 years, and you could get a multiple re-rating because the multiple on this business is so low, trading for single-digit multiple of earnings. You could get a multi-bagger here. I've actually modeled this one out. I think that this has the potential to be a $50 to $100 stock under the right conditions. It's going to take a little bit of time and execution. Nautilus management, not the best out there in the connected fitness space, so they're going to need to really step up their game. But yeah, that's going to be another one that I'm going to tackle, and one that I own some, with the potential for it to become a larger core position at some point if things pan out and the company executes and they're on the right track. But TBD on that one. Let's talk about Smile Direct a little bit. An absolutely abysmal quarter that they announced last week. So, there's a reason that the stock was down, significantly. What was it down? I guess about 20 to 25, 30-ish% over the last 2 weeks, basically. You can see, the stock's down from year to date. Looks like it started the year around $12, and today trades for less than half of where it started the year. Oddly, though, still a relatively large market cap. They have, let's see what their current market cap is. We'll double check that, but I think about $1 billion, if I recall correctly. $1 billion enterprise value, that is. Still about a $1.8 billion market cap. But could this be a lot bigger if things go well for them? For sure. Because if you look at their largest competitor, I know I've talked about this before, but Align Tech, the company that makes Invisalign, the largest competing product for Smile Direct, $54 billion market cap, has been just an unbelievably strong performer over the past 5-10 years. Let's look at a 5-year chart here. You can see multi-bagger, almost a 10-bagger on a 5-year time frame, and certainly way more than a 10-bagger on a longer time frame since IPO. So this is the case where you've got the number one competitor in the industry just getting further and further away from them. But you can see it's a large addressable market. SmileDirect's products are priced at about 50% of the price of Align, so they should be able to take share in this market. They have done a very poor job of doing it so far. But there's been volatility too with Align. You can see Align, back in the 2018, 2020 timeframe, was down about 50% themselves. So, these businesses, it's still early days, I think, in the global penetration for some of these products. But let's talk about the Q2 quarter. Q2 quarter was absolutely terrible. They missed guidance massively, and their excuses for why they missed guidance was pretty weak, to be honest. They basically said that they missed guidance for Q2 because of economic conditions in their largest states. They made this claim that their largest states like Texas and California and Florida are still seeing relatively high unemployment rates, and that's kind of true, but that really is not a change from what we saw in the prior quarters. So that was, I think, a very weak excuse. The other thing is, they talked about a cyber attack. The cyber attack was unfortunate, and you can maybe blame them for not taking enough precautions there, but their systems were down for about a week in the second quarter because of a cyber attack, and they eventually got the systems back up, and that way they could send customers products and do the measurements and stuff like that. So that had a slight impact. It actually had a slightly less impact than they had originally estimated back in April, but that was one of the reasons given. And so you had cyber attack. You had what they call these macro factors, which is 40% of the nation's jobless claims are in their four largest states: California, New York, Illinois, and Texas. Well, if you look at those states are some of the three of those four states that they mention are three of the most populated states in the country. So they're always going to have a large percentage of the nation's jobless claims. So again, I don't buy that excuse. I don't buy that excuse at all. The other excuse they gave was that the change in Apple's privacy tracking affected their ability to acquire customers on Facebook. I'm not sure I buy that a whole lot either. I will say this, this had a big effect on companies like Wish, gaming companies like Zynga. We saw that in those companies' results. So it's a real thing. When Apple stopped allowing app publishers to track from install to conversion, that did hit their ability to efficiently acquire customers. But it mostly affected the customers that focus on app install ads. SmileDirect doesn't really do app install ads. They do direct to website click ads. And so you did have those ads get a bit more expensive in the quarter because Facebook's CPMs went up for those types of ads. So it did get more expensive, but it really shouldn't have hurt their ability to acquire numbers of customers. It just means that their customer numbers were, or their expense for acquiring those customers would have been higher. So pretty weak excuses. Their last excuse, of course, was international. So one of the big growth stories for SmileDirect is they're trying to move into international markets like Germany and Spain. They're already in Australia and the UK outside of North America. So North America is still their core market, but Australia and UK are doing all right for them. And then they want to open up Germany and Spain as new markets. And I think they even also want to move into Mexico and a few other markets. Now, that's a lot on their plate. That's a lot of markets to be trying to go into at once. So that, I think, is part of the problem, is they're not as focused as they should be. But, they're saying that some of the new markets like Germany and Spain are taking longer to scale than expected. And that makes sense. Those are not English-based countries primarily. A lot of the German and Spanish residents can speak English as a second language, but it's not their primary language. When you watch TV shows, the ads don't come in English typically. So, SmileDirect is having to go in countries where English is not the primary language now. There's cultural differences. There's a different competitive set. So those are always going to be challenging as a growth lever. But nonetheless, that was one reason, maybe one of the legitimate reasons why they said that they didn't hit their target revenue guidance. So you can see here, their Q2 guidance was to do 211 million of revenue, which would have been about 6% quarter over quarter revenue growth. And you can see the impacts here: 9 million negative impact from the cyber attack, 25 million from what they called the macro impact of, unemployment in the states that they're in and stuff like that. Again, what I thought was a BS excuse. And then a very small portion of the misguidance they said was to the slower international ramp up. So again, I think this right here, what they call macro, is probably more like execution misses on their front. And this really does bring up the question, is the model broken for SmileDirect? Because SmileDirect, their core business 2 years ago was to have physical shops where they did a lot of local marketing. And in the physical shops, you not only have people selling the product to prospective buyers, but you also have the ability to do the aligner creation, or the not the aligner creation, but the 3D modeling. So they literally, I think, have a wand. You go in, you sit down in a chair, and they take a 3D model of your teeth and your mouth. And that's how they can send those specs to the factory so that they can manufacture the clear aligners that will allow you to straighten your teeth over like a 6 to 18 month time frame. So these SmileDirect centers were physical brick and mortar locations. And quite frankly, in 2019, they probably got too extended. They expanded to too many of these locations. There were all these SmileDirect locations in suburbs and cities. And like, I know here in Texas, I saw in some of the cities like Austin, Houston, Dallas, there was a SmileDirect in, every like 3 to 5 mile radius, it seemed like. So there were almost too many stores. And what they did when the pandemic hit was they actually shut down most of their, or like a majority of those shops. And so I think initially that was a good idea. You've got to cut the burn rate from the physical locations, which are not going to be having people come in because of the pandemic. So they made the right call there. But I think going forward, this business model has changed. Now, instead of acquiring a lot of your customers from the local brick and mortar stores, you've got to go out and you've got to acquire customers online. You've got to raise brand awareness via TV advertising or other types of mass scale advertising, radio, etc. And so you've got the cost of acquiring customers online is just getting more and more competitive and expensive. And, you've got competitors like Candid and Byte that are also competing for the same customer set. You've got Invisalign, of course, the big boy in the industry that is still doing very well. If we look at Invisalign's actual numbers here, what you see is, pretty strong growth still from Invisalign. Let's look at the quarterly numbers. I'll try to make this a little larger so you can see it. And this is running from oldest to newest. We could always switch it, but so the most recent quarter, I don't believe. Yeah, okay. So these are year over year numbers. Obviously, going to look a little crazy because last year was a much slower year because of the pandemic. But overall, still growing pretty significantly sequentially from the first quarter of 2021 to the second quarter of 2021. Align added about 10% sequential growth in revenue. And then, of course, in the prior quarters as well, they were adding pretty similarly about 8 to 10% of sequential revenue growth from quarter to quarter. So that's like the baseline for SmileDirect, because Align is much, much bigger. With SmileDirect still being smaller and having a product priced at only 50% of the cost of Align's, they should be able to grow faster quarter over quarter. They should be adding at a higher rate, especially given the lower revenue base that SmileDirectClub has. So these are the concerns. I do think the long-term guidance for SmileDirect, if we scroll down to their slides, this is the Q2 earnings presentation. They actually do give us a lot of really good data. They give us a lot of really good data and a lot of good insight into how they're thinking about the business, which is nice. So if you look here, so we can talk about their annual guidance now, which was lowered to 750 to 800 million for the year. By the way, Align does more than that in one quarter, just for perspective. They talk about their growth initiatives as well, which is always good to see. What are the levers that they're going to lean on for growth? Some of the stuff we just talked about, like international markets, they're going to be using new acquisition channels outside of like traditional online stuff like Facebook and Google. They want to also advertise in physical stores. So they want to do not only oral care products that they're selling in retailers to get their brand out there, they want to do TV advertising. And what I think could be the big one for them is they're starting to ramp up their partner network channel, which is essentially partnering with dentists. And Align has built their entire business. Invisalign has built their entire business on this model where they partner with dentists and orthodontists. And it's been an incredibly sticky and good channel for Invisalign. And SmileDirect's whole thing was always we can do it cheaper because we cut out the dentist and the orthodontist middleman. But the reality is, so many customers still rely on the opinions and the the ability to go into a dentist or orthodontist if something goes wrong. And so it requires a lot of this trust when you're doing something pseudo medical, right? To straighten your teeth is almost like a medical procedure, and things can go wrong. So I kind of like that SmileDirect is going to the dentist channel finally to try to get dentists to help them sell this product. And of course, the dentists are going to be able to get a cut of that. So I do think it cuts into the potential overall margin for SmileDirect, but it gives them the ability to utilize that channel, I think, a lot more effectively. So I think that's an okay strategy for them overall. But here's their long-term targets. So their long-term target is to get to adjusted Ebitda, that is earnings before interest, taxes, depreciation, and amortization, an adjusted Ebitda margin of 25 to 30%. They also have said that they think they can grow 25 to 30% in terms of revenue growth year over year for the next 5 or 6 years. Now, they're way off of that right now. They're missing that target, but that's what they think they can do on a longer term basis. So not only revenue growth of 20 to 30% year over year, but also adjusted EBITDA margins of 25 to 30%. Those are the long-term goals, and they give us a pretty good breakdown of how they think they get to that margin. They think they can get gross margins up to 85%. I think they're currently between 70 and 75. Sales and marketing as a percentage of revenue, 40 to 45%, and then G&A 15%. So we're going to look and see how reasonable those targets look. We're also going to see here's my concern. If we look at the balance sheet, you can see that SmileDirect, they have cash on the balance sheet of about $376 million as of the end of the second quarter. Now, if you look at the long-term debt here, they've got 733. This actually understates the amount of debt. They have actually closer to about 747 million of debt, and it's all basically one slug of debt that's a convertible note. Now, they did this convertible note in early 2021. They raised this debt. It's pretty good debt for them because it comes with a 0% interest rate. And of course, the trade-off for that was it's a convertible debt, which means it can convert into shares of stock at, I believe, $18 a share. We can double check that. That means, though, that the dilution from that debt doesn't come into play until SmileDirect is, an $18+ stock, which today would be pretty far from here, right? It would be more than a triple. So, the problem, though, is that this debt, even though it carries a 0% interest rate for the time being, the problem is this debt comes due in early 2026, which sounds like a long time, but it's really not. It's only, less than 5 years away. It's about 4.5 years away. And so where are they going to come up with the capital? They're burning cash right now every quarter. Through the first half of this year, they had negative cash flow from operations of about $60 million, and they spent $45 million at CapEx. So they've burned about $110 million of cash in the first 2 quarters of the year. And I believe their guidance is for about the same level of burn through the third quarter and maybe the fourth quarter as well. So you are looking at, call it 150 to 200 million of burn base case right now annually. And that means they could burn through this cash position, in basically 2 to 3 years time frame. And that of course assumes they wouldn't improve their cash burn, which they intend to do. But if they burn some of this cash and they've got this slug of 747 million of convertible debt due in 4.5 years, you've got an issue, right? You have potentially a debt issue when that debt comes due. Even if they get to cash flow break even and they stop burning cash, you've got to come up with the difference between the cash on the balance sheet and the debt, or you've got to be able to refinance this debt. And you don't want to see them refinance this debt into very high cost debt that either carries a very high interest rate or carries a lot of dilution, aka warrants or stock, especially not if the stock is still down, because that can create a tremendous amount of dilution for the existing shares and cap the upside. So the key concern here for me is what does the cash crunch look like? Can they get to a point at which, in 2 years they're generating cash to be able to put cash back on the balance sheet? What's the differential going to be between cash and debt when the debt comes due? And that's kind of why I want to model this out. So this is probably going to get a little wonky and boring, but let's go ahead and kind of just take a look. And for the first part of this is we've got to assemble some historical data. And so I just created a spreadsheet here. And this is going to be a pretty simplified model here. It's not going to be anything super complex. There's going to be some things I'll ignore and simplify. But let's think about this one's a little tricky because the business model has changed quite a bit in the last year. But I'm going to do my best here. I think we should at least start with Q1 and Q2 of 2021 to put in our historical numbers. And we'll just, we'll add some formatting to this and stuff. And I'll try to blow this up a little bit so that it can, you can see it a little better. So again, we're going to start with pretty basic stuff, and then we can make it more complicated later. But for the revenue line, and we can also break this into, they give us pretty granular data on like international versus domestic. But we'll break that out in more detail later. So let's go ahead and start with Q1. I need to go back here and go to the Q1 10Q, the quarterly filing. And we're going to start with the top line of the income statement. We're going to work our way down to like a cash basis, but we're going to use the income statement as a starter. So net revenue, and you can see here revenue plus financing revenue gets you to total revenue. In the first quarter ended March 31, revenue was, these numbers are in thousands, by the way, which I'll just note that here. I'm going to insert a row here. And we'll just say, I always like to make it clear here that, these numbers are in thousands. So let's just pop back over, 199,461. And we'll format these numbers a little nicer too, like I said. So yeah, this is not the most exciting thing to watch, I know, but we're gonna build this up. Should I make this? I should probably make this a little larger. Let's make this 12. And again, these numbers are in thousands. So revenue. We'll keep going with Q1 2021. So the way that they report their income statement, they report the cost of revenue line. That's going to be your direct costs associated with, the aligners themselves and, any direct store costs and things like that, shipping. So 47,961 is the cost of revenues. We're going to just paint this format here to all this stuff. And then that'll allow us, once you subtract these two lines, obviously you're going to get to your gross margin. Or your gross profit is really what I should call it. And then we'll do a gross profit margin. Can't type today. So then this is just this minus this, basically. We can also make this more clear that like The inputs are in blue, and the formulas that automatically calculate the numbers can be in black. I always like doing that. So if you look at the gross profit margin as a percentage of revenue, we'll make that a percentage. And you can see 76% in Q1. And then the next line is the marketing and selling expenses. This is going to be probably the biggest driver of profitability in the short run. The determination of what margins really look like in both the short, medium, and long run is their efficiency of marketing. And so this is going to be pretty critical, and we can dive deeper into this. But for right now, I'm just going to throw this number in here, 97,123. I'm going to put this on a separate line. What do they call this? It's they call it marketing and selling. So marketing and selling, and I already forgot the number. So 97,123. The other thing that we need to check is if stock-based compensation, which is a non-cash expense, is included in these, because eventually what we're trying to build to here is we're trying to build to actual free cash flow, how much of this cash on the balance sheet is going to get burned, or how much cash is going to get added once they become profitable. So I actually have already checked on that, and it turns out that all of their stock-based compensation expense, which is non-cash, is in the general and administrative expenses line, which is our next line. So G&A expense for short. But I'm going to add another line here. I'm going to look at marketing and selling as a percentage of revenue as well. And the other thing that we could do is we could also look at the incremental marketing dollars and how much revenue is added per dollar of marketing expense each quarter. That would also be really, really important to look at. So let's just go ahead and paint this formula here. So you can see right now, the long-term target, they're actually in their long-term, they were in their long-term target in Q1 when it comes to the sales and marketing expense. 40 to 45% of revenue is their goal. Actually, they were a little bit higher than that in Q1. So you can see not being nearly as efficient as they hope to be eventually. General and admin. And I'm going to do excluding stock-based compensation. We're going to shorten that to SBC for short. So that is, we got to start with the actual general and administrative expense, which was 81,078. But we're going to make this a formula technically. We need to subtract the amount of stock-based compensation. The amount of stock-based compensation in the first quarter was, you can see it here on the cash flow statement, it gets added back because it's a non-cash expense on the cash flow statement. It was 15,159,000. So G&A excluding stock-based comp was almost 66 million in the first quarter. We're going to see that as a percentage of revenue as well. It's about 33%. So 33% of revenue, that's high. G&A as a percentage of revenue at 33%, I can tell you, looking at other companies, is very high. Over time, they're really going to need to keep that number flat or reduce it. And that needs to become a much smaller percentage. In fact, they want to get to 15% G&A as a percentage of revenue over time. I want to double check. This almost seems too high for, like, it almost seems like there's a bad one-time expense in there or something. So I'll check on that in a minute. But let's just go ahead and build out the rest of the basic income statement right now. If we go back to the income statement here, the other store closures and related costs, I'm not going to actually include that because it looks pretty small, and I would expect this to basically be a zero. You could make the argument that they maybe still have some stores to close, and those will still come with some costs. We could also look at what that number is in Q2 to see if it's getting smaller or larger. But I'm going to leave that out for right now. And we can essentially already now get to the income from operations, or operating income. I'm just going to call it operating income. And that's going to be gross profit minus marketing minus G&A. Pretty simple here for SmileDirect. We could also change this to have a, you know, a parentheses around it. It doesn't really matter. I like it either way. But operating income, we'd also probably want to see as a percentage of revenue. And, you know, then we can think about, so the next thing that we'd want to look at probably is what is depreciation and amortization. That way we can add back D&A to operating income to see what it, like Ebitda or even adjusted Ebitda looks like. So that is going to come from the cash flow statement because that gets added back to net income to bridge to cash flow from operations. So if you look at depreciation and amortization here in the first quarter, it was $16,460,000. So we could get, now we can essentially get to, we'll just remove this line here. We could now get to a Ebitda, and that would just be the operating income plus D&A. So Ebitda, and then again, we'll do Ebitda as a percentage of revenue. So now we have Ebitda as a percentage of revenue. I'd be curious to look at what they give us for their adjustments to Ebitda. They do adjusted Ebitda as a non-GAAP metric that they give us. So you can see here how they're kind of doing it. And it looks like to me, here's the bridge of how they get there. So they get there by taking net income or net loss, adding back D&A, adding back interest. We haven't deducted interest, so we don't need to add that back yet. They add back the income tax expense, which we didn't deduct, so we don't need to worry about that add back. They add back the store closure costs. We didn't deduct that, so we don't need to worry about that. There's a loss on extinguishment of debt of $47 million. And then here's stock-based compensation, which they add back. We've already done that. And then they've got some other non-operating general and administrative losses. What's up, John? Good to see you, man. So yeah, so we pretty much have everything in our numbers except for this loss on extinguishment of debt. And that might be why we saw such a large G&A number. Nope, it actually was not included in G&A. You can see here it's below the interest expense line, so we didn't penalize them for that in our numbers. So this actually looks like a correct-ish Ebitda number. So we had their adjusted Ebitda at around $5 million. Let's double check again. I'm just going to do Control F and search here real quick. And basically, yeah, 4.918 is what they said that their adjusted Ebitda number is, and that basically matches up with ours. So what's up, RH? What's up, Tariq? So yeah, we're seeing pretty similar stuff here, and so that checks out. So that's good to see. Now, if you think about getting down to a cash basis, so Ebitda is kind of this number that we use in financial analysis that kind of represents a, you know, before considering the cost of debt, before considering your capital expenditures, what does, you know, the overall business generate kind of from like a cash perspective. And that's Ebitda. It's not a great number. When you're actually talking about free cash flow, you still need to consider if you have interest costs, taxes, or CapEx. Now, for SmileDirect, their interest on their debt is pretty minimal going forward because they just raised that convertible debt, which replaced their old debt facility. So if you look, and we might have to look in the second quarter, or we can look at the announcement of when they raised their capital. I'll go ahead and bring that up just so you can see it. So in February of 2021, you can see initially they raised $650 million of 0.00% convertible senior notes. That means the interest rate is 0%. And they ended up, you can see here, they added an additional $97 million and 500,000 of notes. So if you add the $650 million initial and then add that to the 97.5, you get just south of, you get what, 747,500,000 of debt. And I'm actually going to put this on here. So we'll put some rows in between here, but total debt as of, we'll just put this as of the second quarter, since they technically raised it in the middle of the first quarter. but your total debt, 747,500,000. And you know, we'll ignore Q1's interest costs since they had a different type of debt in Q1. And what we really want to have here is CapEx, or capital expenditures. And I'm going to paint these formats so we keep it consistent. And we need to look at the cash flow statement to see what their capital spend's like. Unfortunately for SmileDirect, they're still having to spend a lot of capital. So if we look at the first quarter, again, we're just focused on the first quarter. We're going to fill in the second quarter here in a minute. If we look at their cash flow statement, I'm going to try to make this bigger so you can see it. So the investing section of the cash flow statement has the CapEx they spent. They spent $22,981,000. So 22,981. And I always like to look at that as like a percentage of revenue or a percentage of Ebitda. In fact, probably best to look at it both, but certainly as a percentage of Ebitda, I think is useful. Like, what percentage of the cash earnings are they spending on replacing the capital equipment? You know, this business is going to have equipment that makes the aligners. They're going to have maybe some store-focused stuff, like if they're building new stores or equipment, anything like that. So CapEx is a percentage of EBITDA. We could also do it as a percentage of revenue. It's quite high. It's a high it's a high dollar amount of CapEx still. Even as a percentage of revenue, it's pretty high. It's, you know, it's 11.5% of the quarterly revenue. Oh, come on. I'm going to have to ban somebody from chat here. Oh, never mind. You're speaking in Japanese. What's up? Konnichiwa. Okay, so let's keep going here. So if we take EBITDA, we subtract CapEx, we also really, ideally, we'd want to subtract cash taxes. Now, they're losing money right now, and they have some net operating losses, so they're not going to pay taxes for a little while. But, you know, we can look to make sure they might have some state taxes they pay. On the cash flow statement, you can see sometimes the supplemental items, they'll tell you what they paid for in cash taxes. Doesn't look like they have it here. Yeah, I don't see anything on the cash tax side. But yeah, if you look at the income statement, that'll show you a tax amount, but that's not the actual amount of taxes you're paying on a cash basis. So taxes get tricky when it comes to figuring out cash taxes, but you can see here provision for income tax is pretty minimal. And that's because they're not making money. You know, they're reporting a net loss for these periods. So we could do like an if statement here for cash taxes, and there's like, it's always best to do like a percentage cash tax rate. And I'm just going to assume for right now, again, we can double check this later, but I'm going to just assume that this is like around 25%, which would include state and federal taxes, probably some international as well. So you're going to do, for this formula, you do something like max of 0 or the cash tax rate times your earnings before taxes, which is going to be your operating income, because that's what they report from a income statement perspective, and then minus that's going to be, we need to still subtract interest, but interest is around 0, so we shouldn't have to worry about that. So that should be fine for now. So cash tax rate, again, it's going to be about 0 right now. So, or cash taxes rather. So I'm going to add another line here. Once we have the amount they have to pay for CapEx, the amount they have to pay for cash taxes, we will actually get down to like free cash flow, which is just, in this case, we don't have interest on debt, remember, because the debt carries a 0% interest rate. So we could just do EBITDA minus CapEx minus cash taxes. if you think about EBITDA, if you were to take like that it's earnings before interest, taxes, depreciation, and amortization. So, if you do take out interest and you do take out taxes, and then you do take out CapEx, which is the cash version of D&A, that essentially gets you to your free cash flow number. Now let's just double check. I have this being calculated as basically 18 million of negative free cash flow. If we look at their actual cash flow statement, in the first quarter, this is the second quarter. Let's go to the first quarter again. In the first quarter, you can see the cash flow from operations was negative 28 million, and then they had negative 23 million of CapEx. So they burned like almost just over 50 million of cash. So our number looks pretty far off. What is the major difference? Well, working capital is another item that affects your cash flow. And working capital is essentially just movements in your accounts payable, accounts receivable, your inventories. And so that can create a big difference at times. And it does look like there was a bit of a cash outflow from accounts payable and accounts receivable. And so that could have an impact. So we might need to add in the change in working capital as well. The other things I'm seeing would be they probably were paying cash interest because they had a different debt facility in the first quarter. You can see interest expense was like 17 million. And so that was a significant component of interest expense that they had in the first quarter, but they're not going to have that going forward. So I'm not really going to worry about that when it comes to a modeling perspective. I mean, we could put it in there if y'all want. It's probably not a bad idea. So why don't I just go ahead and do that? So I can do interest expense, and we'll just do an input here. This was 17,566,000. And the other thing we could add in here is like the actual interest rate, which is going to be the percentage of the overall debt, the cost of debt. And I don't know what that was in Q1. We could go find out, but it's going to be 0%. We probably don't even need to add it here. But now we can actually change cash taxes to be the operating income times, or operating income on B13 minus your interest expense, because interest expense is able to be deducted for tax purposes, but it doesn't change the result here. So the interest expense we have now, free cash flow needs to also now take into account the interest expense. So that gets us a little closer to the cash burn. And again, we really should add in working capital, which is going to be the cash that they have. Sometimes working capital is a source of cash. Sometimes it's a drain of cash. And it's the change in the working capital balances. It's the change in inventories. Like if you're Nike, even if you have great sales, if you're increasing your sales over time, you've got to put more and more of your cash into inventory so you can keep, increasing your sales. And so that can be a drain on your actual cash flow, even if you're growing and your business is doing well. That's why working capital, is sometimes important. Some businesses, like software businesses, have negative working capital where they get paid up front for their contracts. So they're taking in cash ahead of when they can actually recognize it as revenue. So those businesses are great because they actually get more in cash in a given quarter than they report on their income statement. So cash flow is higher than income for companies like that have negative working capital. I define working capital as and we go to the balance sheet for this, the current assets minus cash. So this would be in the first quarter, 698,896 minus the cash of 434,545. And then from that quantity, we take the current liabilities of 170,898, and we exclude from current liabilities the current portion of debt, which here was 10,918. So essentially working capital is just over 100 million in the first quarter. And then we'll calculate the change in working capital from Q1 to Q2 and all the quarters going forward once we have that. But we could also calculate it. If we go back to Q4, we could calculate what it was in Q1. But we could also look at it here in the cash flow statement, it looks like it was, you know, -6, -5, -20, -15. It looks like it was about -18 million, somewhere between -18 and -20. So if we just kind of ballpark that and say the change in working capital was like, it was an increase of 18 million, then we'll just say that free cash flow, you subtract an increase in working capital. So that actually does get us now to pretty close to what they really burned in Q1. So that's looking pretty good now. And we're gonna make this, let's fill this with some color just to make sure we know it's important. So now we have Q1 and we have the structure starting to work in our model. And I can go ahead and fill in Q2. Now, the other thing that we probably want to add here is the total cash balance. And the total cash balance obviously just comes from the balance sheet. So we get, on the balance sheet for Q1, there was 434,545,000 at the end of the quarter. 434,545. Go ahead and, you know, we're gonna just make this blue like every other input. You guys still with me? Is this making any sense? I promise it'll look clearer once we fill more of this stuff out. And you're gonna see, we're gonna go Q3, we're gonna start to forecast the estimates for Q3, Q4. And what we could do is actually, we could do it annually, we could do it quarterly. I think probably be fine to do it quarterly or annually in this case. Annual will be a little bit quicker. We could also do a combination. We could forecast like the rest of 2021. So that way it would be like 2021 estimated, 2022 estimated, 2023 estimated, 2024 estimated, 2025 estimated. Actually, we should probably go out to 2026 since that's when their debt expires. So that is probably what we'll want to do. Of course, 2021 for the full year will just be adding up these four quantities from the quarters. So let's go ahead and fill in Q2. So now we have cash flow, we have total cash, total debt. We could also add in net debt, which is the total debt minus cash. By the way, we should fill in debt for Q1, might as well. Debt in Q1 was, it looks like 734, 737. And then to that, we add the short-term debt that came due as well of 10,918. So they had, you know, in the first quarter, they ended the quarter with 434 million in cash, 745 million in debt. Net debt was your debt minus your cash. If your cash is higher than debt, then you have net cash, or you could say your net debt was negative. And that's just going to be a formula, so we'll just copy that over. All right, so now we have Q1 mostly filled out. We have cash flow in here. Am I forgetting anything? Let's see, we've got cash balance. The other thing we could do, I want to make sure that we know that this is end of period. So I'm going to put EOP to just denote that this is end of the period. I always like to do that for like quantities. You know, you have the flows and then you have your quantities that are at the end of the quarter. All right, so let's fill in Q2 real quick. This shouldn't take us very long. We're just going to copy over the formulas in black, and then all we have to do is fill in the places in blue that are the inputs. So we'll just go ahead and copy our formulas over. And in fact, we could copy over the formulas into more of the cells, but this working capital number is an input. And this So all right, let's just fill in revenue for Q2. We're going to open up the quarterly filing for Q2. This is going to go a little bit faster now once we get all these numbers put in, and then we can do our forecast. So for Q2, they did 174,181,000. You can see that was actually down. So 174,181. And cost of revenue was 45,860. So if you look at gross margin, you can see their margins got worse in the second quarter, and revenue was actually down from Q1, which was unfortunate because they have, they've said their goal is to grow between 5 and 10% quarter to quarter. There is some seasonality in the business, but they were expecting to grow, and they actually shrunk a little bit. All right, so marketing and selling costs for Q2 were 95,943. Again, it's pretty high. I mean, 55% of revenue marketing was in the second quarter, and that is, that's high. They need to get back. Their target range, if you recall, is to be at 40 to 45% if they want to hit their target Ebitda margins and be profitable. For G&A, again, also highly elevated, 85,042. You are looking at 49% of revenue G&A made up. That's a lot. Let's go ahead and look at the D&A expense on the cash flow statement. There was in the quarter, so this is for the cash flow statement is 6 months ended, so we need to take this figure and subtract the amount that we already have in Q1 to get the Q2 amount. So 33,169 through the first 6 months. We need to subtract the 16,460 from the first quarter, and that gives us 16,709 was the amount of depreciation in the second quarter. So you can see Ebitda went from positive 5 million in Q1 to negative 36 million in, I'm sorry. You know what? G&A, I did not exclude stock-based comp, so it looks a little worse. So let's exclude stock-based comp, which is a non-cash expense. We're just trying to capture the amount of G&A expense that is like a true cash expense. So stock-based comp for the 6 months was 27,167. Let's see if we have, they call it equity-based. I want to see if they give us the number specifically for the quarter, or we can just calculate it. But yeah, so it looks like here we go. So there was 12 million, essentially 12 million, 12,008. So that's what we're going to subtract here. So we think that Ebitda was about negative 24 million. Let's see what they reported for their adjusted Ebitda. They reported about negative 22 million. They've got like some add back here for other non-operating G&A losses, but I'm going to keep that in because I don't know what that is. So for now, you can see they went from about a $5 million positive Ebitda in the first quarter to they're going the wrong way. They're actually lost revenue sequentially, and their Ebitda went into negative. The interest expense looks like was 1.939 million. Now it should be close to zero. It's not totally clear why it's not zero, but there might have been some residual costs from the prior debt facility or something like that. We could do a search in the filing and see if they show us why that was that way. It could be, so it looks like it is non-cash interest expense. Sometimes the way that they account for convertible debt is to assume that the cost of the convertible debt, like if there's essentially the convertible option does have a cost to the company, or if they've done some type of transaction to hedge out the potential future dilution, that can create some accounting expense that's non-cash. So that's probably what we're seeing here. There could also be some debt issuance costs. So they issued that debt in the first quarter, though. I wouldn't expect there to be any cash debt issuance costs in the second quarter, but you can see the overall cost of issuing that debt does get amortized over the life of the debt. So that's probably where that interest expense is coming from. So if we want to change this to like cash interest expense, that'd probably be a better way to do that. And I don't think they paid any cash interest expense, since all of their debt now, as of the second quarter, is 0% cost of debt, the convertible note. So I'm just going to change that to 0. And let's see. And you can see that too in the adjusted EBITDA figure that they give. They just add back the amount of interest expense that they had on their income statement. They just add it back to get to adjusted EBITDA. So there was 1.939 million of interest expense on the income statement. They add that back to bridge them to adjusted EBITDA. 1.939 was the number, right? If we look on the income statement, you'll see that interest expense 1.939 million. So there you go. So their cash interest expense, I believe, was basically 0 in the quarter. So moving down, let's look at their capital that they spent in the second quarter from the cash flow statement. So they spent, it looks like 45,303 through the 6 months. So if we take that 45,303 and again subtract what they spent in the first quarter, we'll know what they spent in the second quarter. So the capex that they spent in the second quarter was about 22 million again. And cash taxes again was probably 0. Working capital now we can calculate as well. So if we go to the balance sheet, if we look at the calculation that I always use is to take current assets minus short-term debt, current assets minus cash, subtract from that quantity the current liabilities minus short-term debt. So 642,004. Let's subtract the cash of 376,648 at the end of the quarter. And then from that quantity, let's take current liabilities, 163,496. And then we need to exclude any short-term debt, which I don't believe. It looks like, is this Q2? There's still 10,681 of short-term debt, which is strange. 10,681. All right. So working capital also went up. So your change in working capital is going to be the difference in working capital from the prior period. This is working capital end of period. Oh, running out of water here. All right, so stick with me here. We've got the change in working capital. Also, they burned just over 50 million in the quarter. If you look at your cash flow calculation, it's your adjusted EBITDA minus your cash interest, minus your capex, minus cash taxes, minus the change in working capital, and you have basically negative 54 million. Now, if you look at the change in cash balance, their ending cash balance was 376,648. So what was the difference there? Let's just take that difference real quick. The change in the cash balance was about 58 million, and we calculated free cash flow at about negative 54 million, so very close. So our numbers are roughly in the neighborhood, which is good to see. And going forward, what we're going to do is we're going to look, when we do our projections, what we're going to do is we're going to see how the cash balance changes over time using our forecasts of free cash flow, which of course is going to be based on our forecasts of what is revenue, what is selling and marketing costs, etc. Just to see real quick what happened here, you can see that marketing was basically flat. It was 1 million less than the prior quarter. It was at 96 million. G&A actually went up 8 million, or what is that, 7 million or so. So you had an increase in total expenses. Like if you look at these two line items added together, right? It was 169 million of expenses versus 163 million of expenses in the prior quarter. So you had more in expenses and less in revenue. Almost what, 15 million of revenue lower. So you had less revenue and more expenses, and that's why you ended up with this higher operating loss. I mean, again, just a very bad quarter overall. the marketing dollars are not adding revenue. You know, if they're going to be still spending this amount of marketing, the same amount of marketing, you want to see the same or more revenue. Same thing with G&A. They're going the opposite way. That's the concern in the short run and maybe in the long run as well. So let's look at the guidance for Q3. For the rest of the year, they may not have even given Q3 guidance. I think they gave guidance for the rest of the full year. Let's just search it. This is their second quarter earnings presentation. So for 2021, they expect 750 to 800 million, and we would expect a higher Q4 than Q3. Can you guys see this okay? So we would expect a higher Q4 than Q3, driven by typical seasonality, along with the ramp in Germany and Spain. They expect continued macro headwinds in Q3. And then... yeah, they assume that they're going to have some success with reallocating marketing dollars from Facebook to TV, some success in Germany and Spain, more partnerships with the dental groups and the dentists and the orthodontists. And they expect that gross margin will be mid 70% range through the second half of 2021, sales and marketing 50 to 55%, and G&A dollars expected to grow slightly. All right, so that can help us for our projections. And what we could do is we could do Q3 and Q4, or we could just go ahead and move over to the 2021 full year estimate. For now, we could just go to the full year estimate. I'm going to go ahead and take these and just do a copy and paste so that it copies over the formulas, and then we'll just replace the numbers in blue. So for them to get to 750 to 800 million, if you were to get to the bottom end of that range of 750 million, if you subtract what they've already done in the first half of the year, that would imply about 376 million of revenue. Now, if you were to take that number and divide by 2, you're looking at an average of about 188 million a quarter. Of course, they said it's going to be back-end loaded, meaning it's probably going to be lower than that in the third quarter, and then and then higher than that in the fourth quarter if they can hit their goals, right? You know what? Why don't we go ahead and just do it by quarter? I think that'll be easier. I'm going to delete all these inputs real quick so that we remember to put them in fresh. All right, so Q3, do we expect it to grow over Q2? Probably not. Like, my guess is maybe they can keep it flat. What if we assume then, I'm going to go ahead and copy this over as well. If we assume revenue is about 175 million, which would be just slight growth in Q3, they said again that they expect that and we could also, by the way, look at the analyst estimates for SmileDirectClub. Like if you go to this estimates tab in Koifin or Seeking Alpha, we can go and look at the earnings estimates by quarter. So you can see here for the September third quarter, looks like for this year, estimates are about 183 million. So that's a little higher than what we've got in there right now. We could put in maybe 180 million as a starting point. And then for the fourth quarter, they do think that they're going to get some seasonality bump, and hopefully some of their initiatives will start bearing fruit. Analysts have a 203 million estimate. I'm not sure. I think almost like I'm going to play devil's advocate. I'm going to say that I don't think they're going to necessarily hit those targets. So I'm going to do 195 million, which would still be pretty significant growth over Q3. And then their own guidance said that they were going to do a gross margin in the mid 70% range for the second half of 2021. So this is where we flip to actually having projections. So here is where we're going to actually change this to a percentage input, and this will be the formula. And so this will be the gross margin percentage times revenue. Oh, sorry. Let's do that again. This needs to be an input, and if we do that, then we can calculate gross profit as our gross margin assumption times revenue. And we can also back into the cost of revenue, which is now just the revenue minus gross profit. So that becomes a formula. And the way that we forecast is to have our input be the gross margin percentage. Man, I'm thirsty. Okay, so we've got our revenue estimates. The other thing that we could do here is we could add a revenue growth rate. Percentage growth rate quarter over quarter. We could also do a year over year growth rate, which is, we could just put in there as well. Because eventually we're going to move to annual forecasts and we're going to need to do the year over year growth rate. So for right now, we can just calculate this. What we could do, I just have these revenue estimates in here. And then we could have this be the sequential growth rate. So you can see our estimate right now implies about 3% quarter over quarter growth. And this would be about 8% from Q3 to Q4, quarter over quarter growth rates. Our gross profit margin assumptions kind of align with the mid 70% range of their estimates. That's not too far off from what they did. They did 76% in Q1 and just under 74% in Q2. I'm hoping with at least the cyber attack behind them and some other stuff, they can get like gross profit margin back up to like 74, 75%. So I'm going to say 74.5%, maybe even 74% in Q3, and then 75% by Q4 as they get a little bit more efficient. So that, again, that gives us our, let's copy this over. That gives us our gross profit numbers and our implied cost of revenue. Now, moving down to marketing and selling. Again, we're going to change this to an input, and then this becomes the output because we're now doing a forecast. So this becomes the formula. So the amount of marketing and selling is our percentage of revenue estimate times revenue. And this, I think, we'll just put this at 55 for the moment. And we'll put this at 40 and then 35 or something like that. We'll adjust these estimates in a minute. So G&A, same thing. So now you can see the amount of G&A is a function of revenue, and the amount of marketing and selling that we're expecting is also a function of revenue, and our estimate of the percentage that it's going to make up. So they said that sales and marketing they expect to be 50 to 55%. I'm going to assume at the high end of that range in Q3, and then hopefully a little closer to like maybe 52, something like that. That still has their overall marketing and selling dollars growing. You can see it goes from about 96 million last quarter to 99 in Q3 and 101 in Q4. So those seem like reasonable estimates. On the G&A side, it looks like, let's see what they assume for G&A. G&A expected to slightly grow seasonally. So if that is true, then they're going to be at like 42% in Q3, and then maybe like 40% in Q4. So that still has them growing from 66 and 73 in the first two quarters to 75 million and 78 million by the end of the fourth quarter, or by the fourth quarter. So those seem like reasonable numbers for the time being. That gives you still a pretty deeply negative operating income. For D&A, this is always tricky to forecast. The way that we could do that is like as a percentage of revenue or the percentage of PP&E or something like that. For right now, their spending, you can see their CapEx spend is above D&A, meaning they're accelerating the amount of capital spending they're doing in the short run. So I would expect D&A to creep up over time because they're at a more elevated level of CapEx spending. So I'm going to have this creep up. We're just going to punch some numbers in here for right now and see how that that flows. But we can make that a better forecast in the future. But right now, I'm not going to focus on that too hard. I'm going to keep cash interest expense at 0. CapEx, I don't know what guidance they've given on CapEx. So what I could do is I could do a search here, either for capital expenditure and or CapEx. And, Probably CapEx is how they refer to it in some of their earnings calls and things like that. So you can see here, so they expect CapEx to be around that 20 to 25 million range. The last time they talked about it, though, was like Q3 of 2020. So maybe they have some stuff in this presentation as well. Let's look. I don't see CapEx. Let's look for capital. Capital expenditures. I don't see much. So we don't have a whole lot of guidance on CapEx right now, but let's just assume they're going to be in that 20 to 25 million range a quarter for right now. It looks like they've been doing that consistently. So I would like to see them get more efficient with that, but until I see that or hear that from the management team, I'm just going to keep that number plugged there for right now. And that's pretty high. Again, like I said, that's about 10 to 12% of revenue is high for CapEx. I mean, that's high. So working capital is going to be one of those things that's hard to forecast, but we need to try to do something with it. If they're growing, I would expect working capital to grow. This is a positive working capital business because you can see, let's look at what makes up working capital for SmileDirect. It is, stuff like, obviously the obvious stuff like accounts receivables got a pretty big balance. So they've got receivables from customers, and then they've got some inventories of the aligners, I'm sure, and some of the equipment. And then they've got some non-current AR as well. That's going to be for the financing. They finance some of their customers' purchases. And then on the liability side, that's kind of offset by some accrued liabilities. That's like normal, like payment terms for paying their suppliers and stuff like that. And then deferred revenue, which is going to be revenue that they haven't been able to recognize yet, but where they've received the cash up front. So it means probably something they haven't fulfilled for the customer yet, even though the customer's given them some cash. But it's not a huge number. So most of what the working capital stems from is this accounts receivable, which again, I think is because they extend financing for certain customers that want to pay for the retainers over time. So I do expect working capital to grow with revenue growth. I'm surprised it grew in Q2 despite the revenue shrinking though. And one way that we could look at working capital is as a percentage of revenue here. So if we do that and put that in, we can see what it was in the first and second quarter. And you can see that it was like, 50, that can't be right. Is that right? Well, I guess that's as a percentage of quarterly revenue. So in terms of annual revenue, it's probably something like 15 to 20% of, or maybe around 15% of annual revenue, which is again pretty high. So, the cash drain on this business is significant from a CapEx perspective, from a cash burn, not being profitable yet, and from working capital. So working capital, CapEx, and not being profitable is kind of killing them right now. So this looks like if we assume, maybe we could try to do a forecast here of quarterly revenue. I'm just going to punch a number in though, and I'm going to say working capital maybe kind of sticks around. We don't have revenue growing that much in Q3 and Q4, so I could see it being something like that. Maybe even a little lower, but let's just say it's something like that. I'm hoping the drag from working capital won't be massive. We do see that free cash flow starts to perhaps get a little better if they can hit these growth targets in Q3 and Q4. Now, if the business gets worse, if they're spending more marketing dollars and more G&A dollars and they do not grow revenue in Q3 and Q4, I mean, this might be, it might be toast for these guys. And we'll see why. We'll see why, because if you look out a couple years, if this business model doesn't start to improve, then the cash burn happens relatively quickly. So speaking of cash, so we think that the cash at the end of the period, the debt level is basically going to remain the same. They're not going to pay any of this debt off until it's due in early 2026. So we can keep this debt level constant. However, the cash level now is going to be a function of the cash balance in the prior quarter and the amount of cash that they burn overall, or the amount of cash they generate in the current quarter. So we take the end of period cash balance from last period, and we add the cash flow from the current quarter. Now you can see the cash flow is negative, so the cash balance is getting smaller. So already by the end of the year, remember they started the year with $434 million of cash, but already even under these projections, by Q4 of this year, they're going to be down to $284 million of cash under our current estimates. So you can see the issue here. Net debt is growing, cash balance is getting smaller, and that's just we've just modeled through the end of this year. Now, where things get interesting, right, is it's possible that things start to work for them and the business starts to turn around. Maybe these estimates are too low. That's something we have to keep in mind too. We're only using one set of assumptions. So eventually in this model, we can build out several different sets of assumptions and see what the numbers look like under those sets of assumptions. But for right now, we'll stick with one set of assumptions. And I'm going to go ahead and take the 2021 is just going to be the sum of all of these. And you can see right now, we have them slightly missing their annual estimate for revenue. They did, what was it? They said in their guidance that they think they're going to do 750 to 800 million for the full year. We have them increasing revenue sequentially in both Q3 and Q4, but we have them essentially just missing the low end of their estimate. And I think that's kind of appropriate right now, given how poor the execution has been and the fact that they've missed their guidance in, I believe, the last 2 quarters, or at least the last quarter. And they had all these issues with the cyber attack. They're not spending their marketing dollars efficiently. I think it's okay to be at the low end of their guidance until they prove that they're turning the ship around. So our estimate right now is for about 749 million of annual revenue. And we could also just add up, we can again just sum up the cost of revenue, and that will give us what we think the overall estimate of gross profit for the year is. We can also just sum up these lines too instead of making it a formula. And this is kind of what we're just kind of seeing what the result of our projections for 2021 look like on a full year basis. And you can see marketing as a percentage of revenue will end up being about 53% for the year. Under these assumptions, I'm just going to go ahead and just keep summing all these up. And then operating income. Easy enough. And D&A. Could really just copy the sum formula down. In fact, why don't I just go ahead and do that? Cash interest expense, CapEx, and it's going to be about 90 million for the year. Cash taxes. Working capital end of period will just be the fourth quarter end of period number, because again, that's the fourth quarter is the end of the year. And the change in working capital for the year will just be the sum of the 4 quarters. And free cash flow, 199,877. We'll just double check by summing these 4. Looks like it matches up. And total cash end of period is going to be the end of the fourth quarter. And total debt is going to be fourth quarter. And net debt, boom. So now we have our overall numbers for 2021. Now I'm going to go ahead and look at the revenue numbers for 2020. If we go to their 2020 10K, we scroll down to the financial statements here. You can see, I just want to pull their revenue number to look at what the overall growth rate for the year was. So they had 656,780 in the prior year. So the growth rate, if our forecasts are correct, 2021 annual growth rate will be 14%. So they actually, if they hit these projections, they'll actually have grown about 14% in 2021. But you can see that, that's probably not a very good rate overall, given the fact that They shrunk a lot in 2020 from 2019. So if you look at 2019 pre-pandemic, they did 750 million of revenue, and we have them, essentially hitting around that same amount. So almost no growth from 2019 to 2021. But obviously 2021 is better than 2020. So interesting to note that. But now we can actually roll forward. So the rest of the work here to be done is to forecast 2022 through 2026. And I'm just going to go ahead and do that real quick, and then we'll wrap this up and we'll talk about some other stuff. So for the revenue for 2022, what we can do is we can assume like a revenue growth rate. So if we assume like an annual growth rate of revenue, we can essentially then forecast revenue just becomes the prior year revenue times 1 plus the growth rate. And then we have a revenue forecast. Now, where do we get these numbers from? These are going to be key inputs. I'm going to put those in yellow and in fact, make these red. And that's going to be a key question is, well, what do we think they can grow at? Remember, their long-term growth rate projection is 20 to 30%. They think they can grow annual revenue for the next 5 years at least at 20 to 30%. Now, we only have them doing 14% this year. So unless they really turn the ship around, I'm not sure they're going to be hitting the 20 to 30% because they haven't shown us recently that they can do that. So I think, for right now, for my base case, I'm going to assume, maybe 15% if I want to give them credit. And you could argue whether or not these numbers could be higher or lower, but let's just say they're only doing like 10% revenue growth. Maybe they'll do 15 next year or whatever. We can play with this. We could also make it a function of marketing and spend and assume they either get more or less efficient with their marketing dollars, etc. I'm going to give them a little bit of credit though, and assume they're still growing and not shrinking. And then this gives us our revenue numbers for the following years. And then for gross profit, same thing like we did before on the quarterly basis, we'll just make an assumption for the overall gross profit margin. Now, if we go back to their slides, their long-term guidance is for gross margin at the 85% level. Now, they're not there now. They've been going the opposite direction. So it's going to take them a while to get there. If they are growing revenue nicely and getting more efficient, I will assume they start to have some improvement. Maybe they go from 75 to 82% over this time frame. These are just, kind of basic assumptions. I don't have a lot of thought behind these right now. We can go in and really solidify these later. But for now, that's where I'm going to get the gross profit numbers using my gross profit margin assumption. And I'm being a little bit conservative. I'm assuming at least that they're not going to get to the management targets. And then cost of revenue, of course, is just the revenue minus gross profit. So now we just do the same thing like we did before on these. We're going to assume a certain percentage for the marketing and selling and G&A as a percentage of revenue. And if we do that, again, their long-term targets for marketing and selling is to be at 40 to 45%. It's going to take them at least some amount of time to get there because right now they're at 55%. And I think that it's going to take them a while to figure out this marketing mix. They're shifting marketing dollars from Facebook to TV. They're doing more brand marketing as opposed to performance marketing. We know performance marketing just online at least just continues to get more competitive. So I'm going to assume in 2022 they get maybe a little bit better. Also, they're growing revenue, so they've got a little more headroom. But let's just say that they're at 50%, which is going to be still higher than their long-term target. We could assume something like this, where they get down to like 46% of revenue by 2026. Again, their long-term target is 40 to 45%. But do we give them full credit for that? I'm not sure I see enough yet to give them full credit. So let's just assume that these numbers stick. And that means these are our marketing and selling numbers. And then G&A, same deal. their long-term target for G&A is to be at 15%, but they're at like 40% right now. So they've got a long way to go to leverage the G&A dollars. I don't know why they're spending so much on general and administrative costs, other than the fact that maybe they're expanding internationally, and so they're having to add headcount in their international offices and stuff like that. But I do think this is a line that they can leverage a little bit better than like the marketing and selling line. They should be able to keep these expenses at the corporate level a little bit more fixed. We could also assume a percentage growth rate in G&A. That may be one way to do this. And if we did it that way, you could see that, you know, this becomes our input. Let's say they grow G&A at half the rate, 0.5 times the revenue growth rate. And if we do that, by the way, I'm gonna put these in critical inputs as well. Gross margin should be a critical input as well. Just making it clear that these are our critical inputs. I'm gonna make this red. And G&A, if we're going to use the percentage growth rate method, would be 1 plus the growth rate times the prior year's G&A level. That would give us the estimated G&A, and then this could just become a formula again. So you can see, if we assume that G&A grows at about half the percentage rate as revenue, then they do get an improvement in G&A from about 40% G&A as a percentage of revenue down to about 30%. Now, I think it could actually even be faster than that. But you can see the total dollar amount of G&A added would be, it would go from about 300 million in 2021 or 292 million to about 385 million. So they still add about 100 million of G&A over 5 years. Maybe that's too aggressive. Maybe what we could do is we say, G&A grows at 50% of revenue, then at 40% of revenue growth rate, then at 30% of revenue growth rate, something like that. In which case, you know, improve a little bit more. I'll give them that credit for now. So then operating income just becomes like before. It's just a formula, which is the gross profit minus marketing and selling minus G&A. And you can see they don't become profitable really. They become break even around 2024 under these assumptions, and not profitable really until 2025. We can also see the percentage of revenue. Now D&A, like I said, D&A is a little tricky. I think we have to eventually assume that D&A works its way up to the level of capital spend. So I think, you know, we can just go ahead and we can make this a better estimate at some point. But for now, I'm going to assume we'll just punch some numbers in. They're spending right now about 80 to 90 million of annual CapEx. So I'm going to assume that it gets kind of up to that level, or maybe even a little higher at some point. Probably needs to look something like this, right? We'll go and firm up these assumptions later. It's not the most important one, but could be something like that, maybe. We could even, you know, do something like this, right? Sorry. 82. Make this like something like that. It probably looks something like that. Because you have the capital spend increase, eventually D&A from the income statement catches up as you depreciate your equipment that you've been buying. So eventually it catches up and should, in a steady state environment, match the amount of CapEx from the cash flow statement. So that allows us to calculate Ebitda. And then our Ebitda margin. You can see again, Ebitda doesn't become... Ebitda is not positive. When you look at adjusted Ebitda, it doesn't become positive until 2023. That's when they become profitable, before you consider things like taxes or CapEx. Now, cash interest expense, I do expect to be 0 through this period, unless they add debt to the balance sheet, which we can incorporate later, but I'll just punch it in as 0 for right now. CapEx, what I will do here is do a assumption for the percentage of revenue, and that will then give us our CapEx number. And we want to make sure that these numbers make sense. So if I assume, CapEx has been running about 10, 12%, I think they need to get more efficient with this. I don't know. I don't yet have a reason to believe that they will get more efficient with it, other than just growing revenue faster than their capital spend, which if they hit their growth targets, they will do at some point. But let's just assume then that, they kind of get a little bit more efficient over time and get it down to like 10% of revenue. In which case, you have CapEx still grows over time, just a little bit slower than revenue, hopefully. If they are growing revenue, they're going to need more machines to make the aligners. They're going to have, obviously, this is a somewhat capital-intensive business. They do have capitalized software as well, so there's going to be some growth in capital spend if they're growing revenue. But I do give them credit for being a little bit more efficient over time and just being able to leverage on the CapEx line a little bit. Now, cash tax rate, I'm just going to have them, here, if we copy these numbers over, sorry, let's just see here. They start paying taxes as they become more profitable in like 2025 and 2026. However, they've got some net operating losses that they are going to be able to use. So my guess is we could probably just zero out taxes during this entire period. And I'll just go ahead and do that. I'm just going to go ahead and plug that in, even though that's not the best way to run taxes in a model. Just to simplify it for right now, I'm going to plug that in. So working capital then, end of period, your percentage of revenue is how we can estimate that. So going forward as a percentage of revenue, this is a tough one, right? It's hard to know exactly what this percentage should be. If we just started out at 60%, then you can just estimate working capital by multiplying that number by the revenue. And that doesn't sound right. Sorry, so this is a percentage of annual revenue. So it's going to be about 1/4 of the quarterly. So that looks more correct. You go from 120 million of working capital up to about 200 million. And I'm not assuming any improvement in working capital intensity. So that's how we get a growing working capital number, because we do have growing revenue. And some of their customers are going to continue using that financing option. So the change in working capital then is of course just the ending working capital for this year minus the ending working capital last year. That's going to be the change in working capital for the year. And you can see we do have increases in working capital going forward. This could probably be a little bit higher, to be honest. If you take 62, 63% and divide it by 4, that's, what is that? Like, yeah, it's about 15 to 16%. So then free cash flow just becomes like before, this formula. And you can see they don't become free cash flow positive until 2025. So in this set of assumptions, they become Ebitda positive in 2023. But remember, Ebitda doesn't take into account capital spending and working capital changes and taxes. So especially when you incorporate the CapEx that they have to spend, you do have negative cash flow. Even though you have positive Ebitda, you have negative cash flow until 2025. So Ebitda goes positive in 2023. Cash flow doesn't go positive until 2025. Let's see when they run out of cash. We know that this convertible debt is going to remain in place until early 2026. Now, we do have 2026 estimate. We're going to have to figure out what we want to do there. But for right now, I'll just plug it. And the total cash end of period is just our cash from the prior period, ending period. And adding any free cash flow. Of course, we have negative cash flow in the first few years. Look where they run out of cash. They actually do not run out of cash under this set of assumptions. They get very close. You can see here, cash balance goes from 284 million at the end of this year that we're projecting to 160 million because they're going to burn 125 million next year. They burn 85 million the following year under these assumptions, which means the cash balance goes down to 75. They burn another 45 million in 2024, meaning they get down to about 30 million in cash in 2024 until they become finally, they kind of break even on cash flow or just slightly burn cash flow in 2025, and which stabilizes the cash balance. And then maybe in 2026, they go cash flow positive and they can start to increase the cash balance again. But you can see, look at net debt. If we copy over net debt grows to pretty high levels. If you look at like net debt to EBITDA, let's look at like a net debt to EBITDA ratio, and they don't have positive EBITDA until 2023. So this ratio won't make sense to calculate until 2023. But let's just take it. Net debt to EBITDA is about, and I'll go ahead and format this a little nicer. And actually, let's make this a little bigger. I'm gonna format it again to 0.0x. So here we go. Net debt to EBITDA, even when the business starts to get pretty healthy in 2025, 2026, is at a very high 4 to 5 times level, meaning that when they go to refinance their convertible debt in 2026, early 2026, they could be in trouble because they're going to have to either pay a really high interest rate because they're going to be still pretty leveraged on their balance sheet, or will they even be able to refi it, or will they have to issue stock or something like that? So that's really the core issue here. We really need to think about what kind of assumptions we might change here for SmileDirect. Can they actually hit their estimated growth rates? We've got them only doing about half of their long-term targets. We don't have them necessarily getting to their full gross margin targets either. So maybe we're penalizing them a little too much, but we have not seen the execution yet from SmileDirect that would give us the confidence to have them hitting their long-term projections yet. And therefore, under these sets of assumptions, where I still give them some credit for growth and some credit for improving margins over time, under these assumptions, there's a problem. By the time they get to 2025, 2026, and even though they're hitting free cash flow positive, they've burned a lot of cash in the ensuing years getting to that. And they have this almost 750 million of debt that needs to get refinanced in early 2026. So that's the core problem. And this is the kind of thing we'd want to talk to management about, is like, look, if you're not hitting your targets in year 2, year 3, if you're undershooting your targets, you're going to have a debt problem. And how are you going to deal with it? Are you going to deal with it through dilution? Are you going to have to sell a bunch of stock? My concern would be, like, if SmileDirect gets a little short squeeze, or starts to get back up into that double-digit level, is management just going to immediately sell stock and you're going to get diluted, and it's going to kill any upside in a positive scenario? Let's just play with the revenue numbers real quick. Let's just say by 2023 they're actually hitting like 20% growth rates. In which case, and maybe they do or maybe they do like a couple years of consecutively, and maybe like a little bit higher. If we keep the margin numbers the same, or maybe we'll even give them a little bit more credit, because remember, their marketing and selling is 40 to 45% target. Let's say they're like doing something like this, where they're at something like that. That would be an upside case scenario. And you can see net debt, they become free cash flow positive. It still takes them until 2025 to get free cash flow positive, but they do start delivering somewhere between 50 and 100 million plus of free cash flow. And then maybe it looks a little bit better. Net debt to EBITDA starts to look more like 1 to 3 times. And so they can maybe refi this at a reasonable rate, and maybe they can escape the potential dilution issue. But the key point here is that they've really got to be very close to hitting their long-term growth targets very soon. Otherwise, looking out towards 2025, 2026, they don't have enough time. they don't have enough time. If they're undershooting their, their targets, then, if they're doing kind of more similar to what we initially modeled, then, you've got a problem here where they just don't generate enough cash through 2026 to be able to pay this debt down and have a lot of cushion. So I don't know. I don't know what happens yet. We still need to see more from SmileDirect. I don't really feel confident enough to make my position any bigger. I have a very small position now, underwater on it. Obviously, it's I think about a 1% position for me. Could even make the case here that I should just sell it and move on. I do think there's some upside here. If they could be hitting, if they can start to at some point by like 2025, 2026 be doing north of 100 million of cash flow, then you could imagine some upside for the stock. But I just think there's a pretty significant risk here if they're not just absolutely hitting the ball out of the park by a year from now. Then you got some serious solvency issues. So I don't feel confident at the current time to really think this has a tremendous amount of upside, unless you get like a short squeeze. Obviously, you could have the Wall Street bets. This is a high short interest stock for good reason, right? We see why there's probably a lot of people short this stock. And, maybe you get a short squeeze. Maybe this thing doubles in a couple of weeks because of technical reasons. But from fundamental perspective, hard to imagine until the management team shows us better execution why this thing should trade higher. Yeah, let's double check, Joe. Let's check, Joseph, let's check the share count. So as of the second quarter, you can see on the front page of the 10Q, Class A and Class B stock. It looks like they've got about, 300 and it's what, 380, 390, something like that. 390 million total shares of stock, something like that. So the reason that Koifin and Finviz are wrong is because they're probably only including one class of stock, which would be looks like maybe they're only including the Class A common stock. So Class B, they have two classes of stock. It looks like you could go to their income statement as well and see the fully diluted share count is approximately 387 million. You can see quite the big difference between the basic share count and the diluted share count. And when you look at the fully diluted share count, the other thing we could do is we could check and make sure that the Class A and the Class B are similar. Do they both get the same type of economics? Are they both entitled to normal share, share rights? So in the IPO, SmileDirect issued Class A stock. My guess is the Class B stock is probably the founder stock. But we should double check. So Class B, if we go to the annual report, sometimes that has a little bit better detail. Let's see. So yeah, it does look like Class B is probably founder stock and probably carries higher voting rights. So it does look like the higher share count is the right share count to use, right? Oh, actually, interesting. No, hold on. Shares of the company's Class B common stock do not participate in the earnings or losses of the company and are therefore not participating securities. As such, separate presentation of basic and diluted earnings per share has not been presented. That's strange, right? What is the Class B stock? Is it only votes? Is it only vote stock? Holders of our Class A and Class B common stock vote together in a single class on all matters submitted to a vote of stockholders. and each share of Class B gets 10 votes. Okay, so with each share of Class A entitling the holder to 1 vote, and each share of Class B entitling the holder to 10 votes. So it is super voting stock. So the Class B stock is super voting, which gives the founders the voting control. Let's see. But it's still unclear. So why would Class B include it as diluted shares then? It could be the case that you know what it is? It's probably that Class B is convertible into Class A, which means they can convert into participating shares. It could be that. This is a critical issue in terms of figuring out the actual true market cap. And I'm pretty sure that I've looked at this before, but let's just take a look. We could also look at, so this is the annual report from 2020. Let me look real quick at, I'm just going to open this back up. Oh, thanks, Joseph. Appreciate it, man. Yeah, a lot of experience doing this, but still funky stuff pops up here and there, right? It's always there's always something unique about every company. You see a lot of patterns across companies when you're used to doing this, but yeah, it's one of those things where experience definitely helps a lot. All right, so they include the diluted shares in the annual report as well. So I don't know. Participating, let's do a search here and see if there's any other documents that clear it up. Class A, Class B. Okay. It still looks to me like Class B is like a share, because if you look at the actual financial statements, right, on the income statement, you see that the shares are included in the diluted share count, and you have on the equity side of the balance sheet, you have the Class B stock with the shares issued and outstanding, and you have a par value. And I don't see why these wouldn't be entitled to the. There is a big non-controlling interest though, so that's my guess as to why these are real shares. So it's it could be the case that, like, for whatever reason, the Class B shares have a slightly different legal structure, because you do have a big non-controlling interest here, which if the income was positive, like if you look in years where, if they have they reported a profit ever? I think they have, but let's just double check. If they report a positive profit, then the non-controlling interest actually should have a positive share of the profit. So if we look at, nope, they've pretty much reported a loss from operations for the last number of years. So your non-controlling interest is participating in the loss. Let's search this for the non-controlling interest. I want to look a little bit more into that. So SDC Inc. is the sole managing member of SDC Financial and consolidates the financial results of SDC Financial. Therefore, SDC Inc. reports a non-controlling interest based on the common units of SDC Financial held by the continuing LLC members. Okay. Future. Okay. So there's an LLC, like a large LLC interest. That may be what's happening here. So SDC Inc. had 115 million shares of Class A outstanding. As of December 31st, 2020, SDC Inc. had 29.9% economic ownership in SDC Financial. So it does look like the reason that. So here's my guess is what's happening here. Class A stock owns SDC Inc. Class B stock is the stock, I guess, that is voting shares in Inc., but doesn't control economic interest in Inc., but probably controls the economic interest of SDC Financial, which has a 70% economic ownership probably of the overall business. So for all intents and purposes, the Class A and Class B both participate in the economics of the business. And you should include both Class A and Class B in the total share count would be my guess. If you look at the total shares out, that is like, let's see if this percentage breaks down similarly. Diluted shares out would be 387.6, and your Class A is 118.3. So, yeah, that's about 30% of the economic ownership. So that aligns. So you are looking at a fully diluted share count here, probably of close to 390 million or so, which means the real market cap of SmileDirect is today, let's use 387. It is about 1.922B or so. So still pretty high market cap, and probably still some downside here if if they don't hit their projections. I wonder, let's look at Koifin. If you look at Koifin, it does report their market cap at 1.9 billion. And then if you look at Finviz, let's look at Finviz. It looks like they're reporting the market cap as 1.9 billion as well. So let's look at Seeking Alpha. It looks like all of the financial reporting services are using 1.88 billion. So they are using the fully diluted share count. But I think we mostly cleared that up. So looking at the model, kind of interesting, right? There's definitely some tweaks we can make to the assumptions, but I think overall we have a pretty good picture that there's going to be, some issues here with the negative free cash flow continuing probably for the next 2 to 3 years at least, maybe longer, and that just means they're going to burn through a lot of their cash, and when they're facing that debt coming due in early 2026, there's going to be some serious negotiations, and it's unclear how that's going to get resolved. So let's talk some other stocks. I know there was a question there. Was it John asking about Nordstrom's earnings? Yeah, so I haven't had a chance to look, obviously, but let's take a look. Let's take a look at these earnings from Nordstrom. I'm not in the stock anymore, so I don't really have a close read on it. I don't really have any pre-earnings spreadsheets prepped or anything like that, but we'll go ahead and read through this. The other thing we could do, let's just take a real quick look at what the stock is doing as far as its reaction. If we do the extended hours here, let's see how it's reacting. Looks like it's down quite a bit after hours. Looks like it gapped down initially on the results and has continued selling off after hours. So down about 8% after hours. So may have missed some expectations or may have given some weaker guidance. Let's take a look. Obviously, sales increased a lot from the time period in the prior year when all its stores were closed. Let's see. The timing shift of the anniversary sale had a negative impact in the prior year. We knew that. Second quarter results demonstrate the strength of the two brands. Okay. Total anniversary event sales increased 1% compared to 2019, which is the pre-pandemic period. Traffic and sales trends were strong across digital and stores. Okay. Let's see. They paid down $500 million of debt using cash on hand. The company remains on track to reduce its leverage ratio to about 3 times by year end. For the second quarter, looks like net sales decreased 6% relative to the same period in fiscal 2019, Of course, they closed, I think, what was it, like 15 or 20 full price stores in 2020. So there's going to be a fall off from that. And I'm not sure what guidance was previously, but we can take a look at that. Yeah, it looks like if we look at maybe digital sales increased 30%, gross profit as a percentage of net sales of 35%. That's pretty decent gross margin for Nordstrom. You'd like to see them in the high 30s, but that's still an improvement over where they have been, I think, in prior quarters. If we take a look at Nordstrom's numbers here in the overall trends, we're looking at quarterlies. And you can see, if we look at the gross profit margins, you can see that they've been working their way back up to that kind of mid-30s level. So this most recent quarter at 35% looks pretty healthy. Now, in previous years, pre-pandemic, they were in that mid to high 30s range, like I said. So you want to see them work that back up. You'd love to see Nordstrom kind of in that 36 to 39% gross margin range. But 35% is solid and still marks an improvement with recent quarters. Looks like it's about flat compared with the same period in 2019. So on a margin basis, margins look healthy. Margins look okay. And I guess the question is sales and guidance, and SG&A as a percentage of sales. Increased a little bit versus like 2019 period. So they are seeing some freight and labor cost pressure. That makes sense. We talked about at the beginning of the stream how the supply chains for a lot of companies are kind of wrecked right now, seeing very elevated shipping costs. Probably going to see elevated shipping costs into the third and fourth quarter for the holiday season because the shipping ports are still clogged and still congested, and you have higher costs being passed on to those buying merchandise. So that probably continues through the end of the year and squeezes margins on anyone that's selling goods that need to be shipped through ports. So that does make sense. So there's going to be a little bit of margin pressure there. Looks like margin probably came in a little bit below expectations. So yeah, here's their outlook. I know this is hard to read because I'm reading it on their website. You can see here's their full year outlook. Looks like they actually did slightly raise guidance here. So revenue growth had been previously at about 25% year-over-year growth for 2021. Now looking at about 35% year-over-year growth. That's great. You'll love to see that. Now, operating profit margin as a percentage of sales, prior outlook was about 3%. Again, that's about half of where Nordstrom wants to be longer term. They're still working their way back up post-pandemic. They're still trying to work their way back up to normalized operating profit margins. I think they can probably get to 45% in a year or two. But nonetheless, they're still below where they want to be right now. So their prior guidance was about 3% as a percentage of sales. Now their operating profit margin is 3 to 3.5%. So despite the pressure from the higher shipping costs, they still are expecting a slightly higher operating profit margin for the year. Everything else looks the same. Leverage ratio target still the same. I think this is actually a pretty solid quarter overall. I don't see anything that terribly concerning. I think maybe the expectations were for a bigger set of numbers and a bigger blowout of the numbers would be my guess. We could also look at what the expectations were for the quarter here on like Seeking Alpha or Koifin. You can see here, like sales, for instance, if we change this to a quarterly basis, you can see, is this still on? Okay, yeah. You can see that it looks like for the second quarter, the estimate for sales is about 3.3 billion. And let's look at operating profit was estimated at about 96 million for this quarter. So they put up about, let's look, they put up operating profit. They put up revenue of 3.56, which was again above expectations. And then on a operating profit basis If we look at earnings before interest and income taxes, about 151 million. So that was again above the estimates. Now it's possible that, because the stock had run up, that investors were already anticipating a beat of the expectations in the guidance. So yeah, I mean, stock is down 7-8% after hours on what I think is a totally fine result. Maybe they just expected a bigger blowout of numbers, but I think Nordstrom's still making progress on the things that they need to make progress on. I definitely want to listen to the conference call and figure out, what's happening in granular parts of the business, what's happening with, cost pressures, things like that, where they expect that to trend, how they expect that to trend, how they're thinking about the store base, how they're thinking about inventories, things like that. So, I'd absolutely want to get that kind of detail from the call. But just looking purely at the numbers, I think seems pretty okay. Yeah, I mean, they're definitely seeing people come back into the stores, which is great. So yeah, I mean, sales beat expectations, operating profit beat expectations. Maybe people expected them to beat more. Maybe they expected a full year guidance to get raised more. But overall, I think looks healthy. If you look at valuation, I mean, still not valued that aggressively. Let's look at If we look at like the valuation multiples, looking out a couple of years, looking out to like next year and beyond. Let's just pull up. You can see here, and these numbers are actually going to be a little bit cheaper given the price after hours. But you can see here that trading at about 8 times next 12 months Ebitda, and not reporting positive earnings, I guess, yet. But let's look at the estimates. Non-GAAP EPS estimates looking out to 2022, 2023, start to get back up into that $2 to $3 range, which is where I think, I said before in the Nordstrom videos that I released last year that I thought that they could earn about $2.50 to $3 in earnings / free cash flow once they get back to like normalized levels. So at $38, it's not like an expensive stock. It's not a cheap stock. 35 after hours, you're looking at, probably like a sub-market multiple of cash flow or earnings, probably somewhere around like the 12 to 14 times range. So I think if this thing got sub 30 again, it would start to look more interesting. And I don't see any problems right off the bat with the report per se. Let's see what the reactions were on like Seeking Alpha and stuff. Sometimes they give the yeah, so you can see here, like, trades lower even after topping estimates and boosting guidance. So not a whole lot of knock there on Nordstrom, even in the Seeking Alpha. But sometimes the expectations just run up ahead of, of the actual performance. Yeah. Yeah. How long have we been going? Oh, shoot. I've been going like 3 hours now. Is that right? Yeah, I think I may take a break. But yeah, hopefully the Smile Direct stuff was interesting and useful for some people who've been looking at that stock. I'll have to talk more about that one and do some more work on it for sure to firm up some of these estimates that I made. But if you saw any errors too, there may have been some errors, but I think we got most of the way there. So yeah, thanks for joining the stream. I'm gonna try to do more of these Twitch / YouTube streams going forward, just to kind of riff on different ideas. Look for interesting stocks, cover what's going on in the market, cover any questions y'all have, kind of open you up to some of my process, like what we saw here with Smile Direct and building models. Yeah, I'm also creating this thing that I can send out where people can kind of like vote and make suggestions on what stocks you want to see me cover, and I'll send that out later, especially for the members of the Skill Inc. community. But that way you can kind of tell me what you want to see, what you want to see me dive into and research and cover, and Yeah, interesting markets this year too. So a lot of stuff that's down a lot lately, especially in SPAC world and things like that. Definitely, I've been looking at some of the D-SPACs and what's going on in SPAC world. There's a lot to look into there, and yeah, just a fun time. Hoping to get more time to be able to do these streams. So yeah, love the follow if you're on YouTube or Twitch. Just follow me. It should alert you. I think whenever I do a stream, been trying to do streams like I would ultimately love to do streams like in the morning after market open, and then maybe some in like the late afternoon or evening time frame as well. But we'll see. We'll see if I can kind of nail down that schedule a little tighter. But good to see everybody, and thanks for